This video is sponsored by FSA Store, but more on that later. Can you make more from a single stock than your job? Not in a month and not with $100 trades, and definitely not without a plan. But over time, with the right companies and sizing, it's absolutely possible. And today, I'm talking to someone who's done it. Joseph Hogue has been investing for decades, and he has multiple positions where one stock has made more than his entire previous salary. So this isn't a hype list. We're breaking down his top picks right now, his framework for picking stocks, and what would make him buy or sell today. Joseph, thanks for being here.
Kieran, it's great to be here. I appreciate it. Thank you.
So there's this idea of replacing your income by investing in stocks. Is that actually possible?
Well, of course it is. And of course, it's just all a numbers game, right?
And it's a numbers game you can win starting with a pretty small amount of money. In a previous video, Joseph showed how he bought SoFi at $6 per share, riding his 25,000 shares to a $242,000 profit. Or his Palantir investment, which he rode to a $60,000 profit in just 8 months. Two investments by themselves, which made more than he earned early in his career, making $1,000 per month in boot camp, or even $1,300 per month as a corporate. But even today, when salaries are higher, it's still possible to replace a median US income using stock investments. And Joseph walked through the math, starting with a $50,000 a year income.
If that income is $50,000 a year, if you think you can take out maybe 10% of that, then you're going to need $500,000 portfolio to replace that $50,000 each year. If you only want to take out maybe 5% a year, you're going to need $1 million portfolio. It doesn't even need to be all your income, right? If you can replace even half of your income, cut back to half time, or just take some of those freelancing side gigs where you can be your own boss, make your own hours, and really create the life that you want.
So that's the key here. These types of returns aren't normal, but they can happen when you find the right company with the perfect product at the perfect time. The question is, how do you actually find those stocks before everyone else does? So I wanted to understand, how does Joseph go about picking his stocks, as well as what would he buy if he was investing $1,000 today? Starting with stock number one.
First stock, probably it would be within cybersecurity. Okay, one of my favorite themes, and not necessarily the fastest growth theme out there. Obviously AI, some stocks in AI, some of the stocks in robotics are going to grow much faster because those themes are really the next growth themes. But cybersecurity for me is just the no-lose, the win-win scenario here, right? AI is increasing the attack surface. That's going to create more demand for these cybersecurity stocks. Cybersecurity overall spending in IT is expected to grow about 12% a year, which is going to just increase the overall spend to cybersecurity companies exponentially.
So Joseph's first stock is in cybersecurity, but it also teaches us his first rule of investing, which is to invest with a market tailwind in a market that is already growing on its own. Then within the bucket of stocks that follow that theme, we can pick out the stocks that we like the most.
When we look further down into some of those stocks, one of my favorites is CrowdStrike Holdings, ticker CRWD. With its Falcon platform, it is bar none the preferred vendor or provider for cybersecurity. Has done really well in the past. Had a few hiccups there, especially last year, but it is going to be a performer, and I think it's a strong pick for probably my favorite long-term growth stock.
So CrowdStrike is a stock I've covered a bunch on this channel. It's clearly riding the cybersecurity wave, but it's not some hidden stock. Its stock price is already up well over 100% in the past 5 years. So the real question is, why buy this stock instead of trying to chase something earlier or cheaper in the cybersecurity space?
You know, in cybersecurity stocks, you just can't wait for them to be cheap, right? This is one of those themes, one of those groups that they are always expensive on a price to earnings, on those price to sales, those traditional valuation metrics, but they just stay that way because the growth is there. And that growth is locked in. Cybersecurity is probably one part of the IT budget for a company that cannot be cut and just has to keep on growing, or they become vulnerable to these attacks. So it's not necessarily a valuation pick. You know, I know a lot of investors missed out on Amazon for so long because that stock looked expensive on a price to earnings basis, and look what it's done over the past 20 years.
So Joseph, you like CrowdStrike at today's prices. What would cause you to sell this stock?
You're really trying to find those companies within those themes that have that durable competitive advantage. So if I start seeing that CrowdStrike is growing its sales much slower than its competitors, then I'm going to start to wonder, okay, is that sales growth, is that market share going to some other company? Obviously, 1 year isn't a trend. I wouldn't sell it after a year, after 2 years. This would have to be something that develops over 2 or 3 years.
So CrowdStrike gives us a great example of Joseph's first rule to invest in a market that's already growing. And that same logic is going to show up in the rest of the stocks in this list too. So part of investing like this is finding smart ways to save more money to invest throughout the year, like using tax-advantaged retirement or savings accounts, like an FSA for tax-free healthcare dollars. But did you know that those dollars can go to a lot more than just over-the-counter medications? And this video's sponsor, FSA Store, helps you get the most out of your funds. FSA Store is a curated site to buy products that qualify for FSA spending. So if your income tax is 30%, it's like getting a 30% discount on all the products. And since most FSAs expire at the end of the year, you'll miss that discount if those dollars go unspent. And medical devices is a surprisingly broad category. You have allergy medications, electronic scales. They sent me this Caring Mill by Aura migraine relief mask. I just take off my glasses and it gives you a 15-minute pressure plus heat plus vibration cycle. It even plays soothing music, but I ended up turning that off. But hey, a 15-minute nap plus a mini massage, that's great. But the best part, it, like all these products, is FSA eligible. You can even buy it and everything on this site using your FSA card, so no submitting receipts is required. So go to FSAstore.com/fintech. If you have an FSA, those dollars are tax-free and they could literally expire if you don't use them by the end of the year. So it's worth checking out FSA Store's collection of products. That's FSAstore.com/fintech or scan the QR code FSA Store where everything's eligible. And now let's take a look at the next stock as well as Joseph's next rule for investing. But this is where Joseph's background matters because he's not just saying buy expensive growth stocks and then hope. He actually started investing in the exact kind of market that burns investors the most. So what is your background with investing? Did you start out with a bunch of money already?
Sure. Well, I got into it just like a lot of people do. I think especially during these times where it's a bull market, everybody's getting rich, everybody's talking about NVIDIA and what's the next NVIDIA, things like that. So I jumped in the market in 1999, the height of that bull market, probably the worst time to start investing. But I was in the Marine Corps making all of $1,300 a month as a corporal there. So I started on this journey, made all the biggest mistakes, made all the mistakes possible. I think I actually started losing money before the bubble burst even on that point. But little by little, every mistake makes you a better investor. You learn from it. You learn how to invest better. One of my best stocks there was Amazon. Bottomed out in 2002 at about almost 60 cents a share on a split adjusted basis. It's split since then. And now it's upwards of around $200 per share. Definitely you could see how finding some of these growth stocks that we'll talk about can take your portfolio up that 20, 30% even a year, and to points where you grow that portfolio and you can replace your income.
So this makes Joseph's stock picks really interesting because he started investing during the dot-com bubble and he learned the lesson of what can happen if you don't focus on company fundamentals. So let's take a look at his second stock as well as his second rule of investing that helps address what to do when there's a lot of hype in the stock market.
Well, this one's going to be a little bit more controversial, but right now I would have to go with a super microcomputer. And I know not necessarily just a little controversial, but very controversial. But it's undeniable that this company has that competitive advantage in AI-powered servers. Okay, if you understand the AI supply chain, you understand that these millions of NVIDIA GPUs that are being used in these data centers, top 4 hyperscalers spending $700 billion this year alone to build those data centers. Those GPUs, you can't just throw them in there. They have to go inside a server. Okay, so I always say that the GPUs, the chips, are kind of like the neurons. They have to go inside the brain, and the server is the brain of a data center, all those connected servers. And that's what SMCI does best.
So clearly a very different kind of pick from CrowdStrike. This isn't software, this is hardware infrastructure. But this is also where Joseph's second rule of investing comes in, which is to invest in a company that has a competitive moat, basically something unique about them that gives them pricing power with their products or services. CrowdStrike had it in both their AI and their large contracts. And for Supermicro, Joseph thinks that their advantage shows up in their their numbers.
SMCI growing sales, growing revenue by about 87% this year alone. And then you look at that, and then you look at the valuation. And I understand what the bears are saying, that the profitability just isn't there. Net profit margin is very low, somewhere around 2 or 3%. Profit growth this year is against that 87% revenue growth is only about 7 or 8%. So obviously there's a disconnect there. That's when you have to look deeper and say, okay, why are they growing sales so fast but aren't able to convert that? I look at SMCI a lot like I used to look at Amazon, right? Amazon, amazing sales growth for so long, no earnings, because it was plowing all of that money back into growth. And then, of course, that eventually came through in earnings. I see the same thing in SMCI, and the valuation is just ridiculous, okay? When you look at AI stocks and AI-related stocks, to find a company that is priced at a market cap of like 0.7 or 0.8 times its sales is just unheard of. Okay, most stocks, I know Nvidia is somewhere around 25 times price to sales. Obviously, this is a roller coaster stock, so if you do get a little queasy when stocks go up and down, this maybe isn't the stock for you. But at this valuation and with that AI growth, that's the stock that I want to own at least for the next 2, 3, 5 years.
So SMCI, it's an interesting mix of trying to ride the AI market while also trying to buy a stock out of value. But before we get to stock number 3, what would cause you to sell out of SMCI?
A lot of the overhang in SMCI has been its management problems in the past, and that's on two sides. One, management just does a piss poor job of managing expectations. All right, they don't do a good job of guiding those expectations with analysts, so that a lot of times 1-2 weeks before earnings come out, SMCI comes out and says, you know what, we're probably not going to meet those expectations, and the stock craters hard. That's what makes that roller coaster ride in the stock, really. The other side is, allegations of fraud over the last couple of years. None of those have panned out. I think a lot of short sellers like to attack the stock because it is so easy to attack because of these past allegations, especially in these last allegations in 2022, 2023. There is nothing that all companies don't do. Just be aware that every once in a while some of those allegations come up just so the short sellers can make a quick buck, and the stock is going to fall on renewed fears on that. So again, it's a roller coaster stock. You look deep into the fundamentals, you look at what this company is doing, how it's riding that AI wave, and you stay focused on it, because it might be at $30 a share here now, but it gets back up to 40, 45, 50 very quickly.
So that second stock, definitely on the higher risk side, but maybe higher potential reward. But we also need to look at Joseph's third rule of investing, because he's not just looking for a big market or a good story. His third rule focuses on the financials that need to back that story up. So this is where your Wall Street background comes into it. You have a CFA?
Well, actually after getting out of the Marine Corps and finishing school, I actually did become an analyst there on Wall Street. I got my CFA designation and really specialized as a top-down analyst. Now you want to find the stocks that are really doing well, that have that durable advantage and are going to do the best within those themes. So that's when you start looking at revenue growth. Okay, which stocks are growing their revenue faster? You're also going to be looking at operating margin. Okay, so which operating margin is just the EBITDA, or some sites just show the operating income divided by the total sales. How efficient is the company? How efficient is management at turning those sales into operating income? But what this is more, it's a clue into which stocks have that competitive advantage in the theme.
So that's the third part of Joseph's framework, to check the financials to make sure 1, revenue is growing, and 2, the operating margin is staying high, so they're not just sacrificing all profits in the name of growth. And it's interesting because this isn't just a checklist of numbers, this is validating that the company actually has a competitive note that is backed up by their real numbers. So let's hear about Joseph's third stock, and then we'll go on to 2 stocks that I would add to the list for $1,000 to invest.
Well, it's back in that AI theme, because AI is everything right now, right? It is truly changing our lives and changing the world around us. So I do believe that not just for those returns and to replace your income, but as kind of job security as well. You need to have AI related stocks, okay? Because when AI does become powerful enough to do a lot of those tasks for us, those companies are going to need fewer people. So you do need AI related stocks. One of my favorite here is SoundHound AI, ticker SOUN. This is one of the leaders in voice assistant AI technology. I think that's probably the next evolution of AI, and SoundHound has a unique capability with its voice to meaning software. Okay, so what happens with a lot of the other voice assistant AI technologies, those platforms have to take the voice audio, your voice coming in, convert it to text, and then convert that to meaning and then back. SoundHound skips a couple of steps there. SoundHound has, proprietary technology that can take the meaning or the audio straight to meaning and then back out to text. So it just enables for a more of a real-time, faster translation and faster performance for its technology. And I believe that's really its competitive advantage here. It's got a lot of corporate partnerships. It's really moving deep into quick service drive-through restaurants. So using that AI technology and that voice assistant in the drive-through rather than having to actually speak with somebody that may or may not even know their own menu. It's very deep into car voice assistants. So it's got a lot of very strong partnerships with big brands.
So SoundHound is not a stock that I've covered before, but you're clearly a fan of their technology. How do the numbers back up this story? And also, what would cause you to sell out of this stock?
Right now, the revenue growth for SoundHound, and we can look this up, is very strong. I know they doubled revenue over the last few years. This year, it has slowed down to expectations for about 37% revenue growth, which is still very strong, just 20% next year. But I believe, as this technology continues to be adopted into AI and into companies' business models, then I think that revenue growth continues. So you really want to watch that trend in revenue growth, not necessarily get worried when it does start slowing down, because obviously any kind of super normal revenue growth of 100%, 40, 50% a year is going to have to slow down as the market gets more saturated with competition, as the market gets more mature. But you do want to watch the revenue growth as well as the operating margin on that. Right now, this stock is on on a GAAP basis, it is unprofitable. Okay, so last year posted negative 13 cents per share earnings. This year expected to improve that to just 5 cents loss per share. But yeah, very good stock. One of my longer term AI related stocks.
So now that we have Joseph's 3-part framework as well as his 3 stock picks, I want to apply that same framework to my holdings to pick 2 stocks to add to this $1,000 list. And stock number 1 for me is going to be Zscaler. This is another cybersecurity stock, so it's riding the same market tailwind as CrowdStrike, but the stock price is down substantially in the last few months, bringing them down to a market cap of just over $20 billion. This company's competitive moat comes from their technology. Zscaler was one of the first movers in the zero trust market, which is basically a way of protecting companies from any kind of intruders from the outside or even within. And what's most important is this is the way that a lot of cloud and AI applications are moving, because if you're going to have an AI go out and interact with the world, it needs to have a way to verify trust with every single surface it touches, every person, every computer, every application. So that's the competitive moat. Let's look at the financials. Here's a chart of Zscaler's revenue growth over time. As you can see, it's been pretty solid. The growth rate was in the high 40%, has dropped down through the 30s, and is now settling down at around 25% growth year over year. Their gross profit has also been fairly strong. The biggest weak point here is the company's operating income, which has never actually been positive. The company is still reinvesting in growth mode. That being said, the trend is in the right direction, becoming less negative, except for in the most recent quarters. So I want to add one rule to this list, which is before buying any stock, you should know what would cause you to sell. For me, what would cause me to sell is if this operating income continues to grow in the wrong direction, their margin gets worse, or if their revenue growth declines substantially. We can see that it seems to have leveled out, and I don't want to see that dip from here. Otherwise, it shows that there's something wrong with the story that Zscaler is selling us. But I do love how cheap this company is. Here's Zscaler's price to sales ratio over time. Right now, it's the cheapest it's ever been at around 7. Compare that to a company like CrowdStrike, which currently sits at a PS ratio of about 20, so 3 times more expensive. So let's look at stock number 5, and after this, I'm going to share the one rule that has made Joseph the most money in his investing career. And for my second stock pick, I got to go with Cloudflare, which is a stock that's up 77% in the past year, and this is a company that's riding kind of 2 market tailwinds. One is the growth in cloud computing. Cloudflare has basically become the only competitor to the massive hyperscalers like Microsoft Azure, Amazon Web Services, and Google. And they are also building services to make it easier for AI to interact with the internet without just breaking the internet's business model. Because right now, a lot of sites are struggling to stay online because AI is scraping them, but the websites aren't getting any ad impressions from that, so they're not making any money. And Cloudflare thinks they can fix that. Cloudflare's moat, again, is their technology. The company's customers currently make up 38% of the Fortune 500, and there's even this meme that the entire entire internet is built on AWS, but then AWS is actually propped up on Cloudflare's network, which is basically running the entire modern internet. So they are deeply embedded in the core infrastructure that keeps a lot of the internet running. Third item, financials. Cloudflare's had exceptionally strong revenue growth. Despite the fact this is a multi-billion-dollar per year company, their revenue growth has actually re-accelerated in recent quarters. And similar to Zscaler, this company does not have positive operating income, but their trend looks okay. They're not becoming less and less profitable over time. They're continuing to reinvest in building out their network. In fact, one interesting note here, if we look at their operating income, it's basically at zero. It's a rounding error in terms of how negative it is. But if the company just stopped investing in R&D for one quarter, they would be profitable. So we can tell that this is a company that is intentionally reinvesting and isn't just not profitable because of a bad business model. What would cause me to sell this company is if it's proven that Cloudflare can't address the current AI situation with the internet, and it starts to impact how many websites rely on Cloudflare services. And I would expect that to show up in this revenue growth before anywhere else. So let's hear Joseph's one rule that has made him the most money as an investor.
I'd say, bar none, chasing your winners instead of the losers. Okay, so many investors, they go out there and they bottom fish, right? They look for the stocks that have been falling, thinking that they're getting a great deal, right? They get a stock and they think it's the next best thing. It starts dropping like a rock. They're like, well, I just want to get my money back. And it becomes that kind of gambler's fallacy. And they just follow those stocks lower and lower and lower. Instead, chase those winners instead, okay? Chase those winners. Nobody that kept on buying NVIDIA over the last 3 years, even as it started getting expensive, even as people started saying, hey, this stock has got to slow down pretty soon. Nobody that kept buying is sorry right now. Cut your losers fast and just put those into the stocks that are rising.
It's that whole idea of trying to catch a falling knife versus just reinvesting in the winners. I always like to say, it doesn't matter where the stock price was before. All that matters is today, do you think it'll be worth more in the future than it is today? And that's really ultimately what it comes down to. Joseph, thanks for joining us today. Thanks for your picks, and we'll see you next time.